Jeff, good to have you back onto the program. Obviously, this time I'd like to talk to you about the gold market and everything that's happened, especially over the weekend, how that's impacting gold in particular. Before we go into that, I just wanted to pick your brain on general financial systems. Obviously, after the US banks 2 weeks ago failed, and now that we've gone into this crisis with Credit Suisse and almost a forced takeover from UBS, is there a general sense that this is the beginning of a wider financial crisis, or is this now that UBS and the Swiss National Bank intervened, do you think this is now simmering down and hopefully settling things down over the next couple of weeks?
I think the answer is yes. I do think this is the beginning of bigger financial problems, but I also think that things will settle down over the next few weeks and few months. We were speaking this morning about the corollary between March of 2008 and March of 2023. In March of 2008, Bear Stearns went bust and gold prices rose very sharply. They went over $1,000 for the first time ever. And I remember telling our clients, okay, stop buying gold at $1,000, buy puts for $900, with I think we were saying August expiration, with the expectation that the price of gold would fall back to $900 within a couple months. And then you could A, sell those puts at a very nice profit, and B, start buying gold again, because the world was shaking apart, but it wasn't imminently shaking apart. And we thought that the gold price would go higher than $1,000, which it ultimately did over the next 4 years, or 2008, 9, 10, 11, but that there was this pause and it would come down. And to some extent, I think we're in exactly the same place. We're seeing some financial crises. We're seeing some bank instability there. What we're really seeing, which is really important, is the extent to which the financial markets are nervous about financial situations and financial stability. I mean, Silicon Valley Bank was kind of an aside as a bank. It was the 16th largest bank in the United States, but it had a lot of strange things that were very idiosyncratic to it. But it didn't matter. When the problems came, there was a rush, not so much to withdraw capital in terms of deposits, but to sell the stocks of the company. If you look at Signature Bank, for example, Signature Bank's deposits are fine, but the stock plummeted, so you had a capital and liquidity issue there. And to some extent, the same was true with Credit Suisse. The deposits were fine. It was more in the stock market side and the share price where you had the problems. So we think this is the beginning. This is a signal of the fragility of the financial system, and more importantly, the nervousness about on the part of investors toward the financial system. We do think things calm down and quiet as they did in 2008, but we do think that going forward 8 or 10 months into the end of 2023, early 2024, you could see a much more significant issues start to emerge.
How much of a role has the Fed had on this, and in terms of just overall confidence with not really being able to keep up with inflation or even stamp it down at all?
Well, the Fed was slow to respond to inflation, but then when it finally caught on, it was very forceful, and it's been very effective since, a year ago. It started raising interest rates in March of 2022, and you have seen 8 consistent months of a slow depressurization of inflation rates. So the Fed is doing exactly what it should do, and it actually should be applauded. I don't agree with the critics of the Fed. I also don't agree with people who say that the rise in interest rates has been unduly damaging to the overall real economy or to the banking sector. I mean, if you go back to SVP, I've always said, I have for years talked about how, the critics of the Fed say, the world was much more stable before the Fed, which is nonsense. It was much less stable. And you had constant bank runs on state banks because the states didn't really regulate the banks. SVB didn't have a risk manager for like a year. And I'm not sure that it even had a chief financial officer for the last 6 or 8 months. And it was a state bank. And it was regulated by state regulators who clearly were doing insufficient audits. So, you've got these problems there. And I don't think that you should blame the Fed, and I don't think you should blame interest rates. The fact that SVB didn't have risk managers or other people who seem to have any knowledge of finance that would have taken into account the rise in interest rates and the expectations of further rising interest rates and acted accordingly, that's not the Fed's fault. That's incompetence on the part of that bank. And it's an incompetence on the part of the state regulators who should have been auditing that bank and saying, hey, wait a second, guys, wake up, have a cup of caffeinated coffee, take a look at what's really going on. So, and I don't know that the interest rates have risen so far as to be a major factor on negative side in terms of the economy or in terms of bank stability. And, we've seen the Fed actually doing a pretty good job of decompressing the inflationary pressures without throwing the country into a recession. We had very strong growth in the third and fourth quarters of last year. We had strong growth in the real economy going into this year. Employment certainly hasn't been suffering from the Fed. Employment is suffering from a lot of other structural problems and fiscal problems and border control issues and stuff like that. So, I'm not sure that I would lay the blame on the Fed so much as I would lay the blame on everybody else.
With Silicon Valley Bank going under, I think that obviously led to a confidence issue, like you were mentioning there, which then I think a lot of, even with the Saudi National Bank, then sort of putting out their confidence in Credit Suisse, which has obviously had a turmoil of 2 years really of different management changes and I guess restructuring to try and get this back into profitability. Following the takeover with UBS, and we've just seen that $17 billion worth of bonds are now essentially invalid and being wiped. I mean, how does this impact confidence in financial markets in general, not only just in Europe, but even in the West? And what's the likelihood that this could happen again in the near term?
I think that the problems with Credit Suisse and the merger into UBS are really shaking the confidence in the banking system. And I think there is a very high probability that you will see further problems with various banks around the world, not just in Europe, not just in the United States, going forward. I don't know that they will appear in the next week or two. As I said, I wouldn't be surprised to see things calm down for 6 or 9 months. But I do think that this is indicative of the extent to which banking reform has been insufficient in the post-global financial crisis period.
You were mentioning earlier there that remind you of 08, and at the time in 08, you were recommending put options at around 900. We just saw today gold touched 2,000 slightly, and it's retracted back down slightly again. But what are you telling investors now? Anyone that's asking you, right, what should I be doing in this sort of environment? What would your response be?
Yeah. We've been telling investors that they shouldn't be buying into this surge, that buying puts and paying for them with call spreads probably would be wise, so that you can protect the value of your gold holdings if the prices fall back, and actually profit from that decline. We've been telling our clients that we do think that gold prices are going to rise sharply over the next 2 or 3 years. We wouldn't be surprised to see another 20% increase in the annual average price of gold between now and say 2025. So we think that the gold price has the capacity to rise much more sharply, but we think that the current $200 increase in gold prices in the last few weeks is probably overdone.
Okay, so essentially 20% annual increase. You're looking at way over 2,500 gold price within the next.
Yes, we wouldn't be surprised to see the average gold price over $2,000 next year.
Okay,
the annual average price.
And then So then I'm assuming with different peaks and troughs, you're assuming that the peaks may be much higher than we've ever seen before. Would that be fair to say?
Yes.
Okay.
I mean, the peak intraday price in the last bull market was probably around $1,998, more or less. And the average price that year was like 1,600. Last year, 2022, the gold price got up to about $2,060 on an intraday price, 2,040 on a settlement base, and the annual average was 1,804, which was a record high annual average price. So we had this weird dichotomy in the gold market last year where people who sell gold, like mining companies or refiners, or use gold, like jewelers or electronics companies, they look at quarterly and annual. What's the cost of my product? What's the price for my product? What's the cost of my raw materials? And they were saying, oh my gosh, gold is at a record high, $1,800. And then other people who have a shorter term perspective were saying, oh my goodness, gold prices have fallen 25%. They were $2,060 in March, and now they're $1,624 as of early November. So you had some people saying, why is gold price so low? It's fallen 25%. And other people saying, gold's at a record price and it's going higher.
Well, it's I always see you as one of the more conservative commentators on gold price. So hearing you say things like this is alarming to me. I mean, what's being factored in to this? I mean, looking into 2024, 2025, I assume that, are you anticipating a recessionary period over the next year? Is it just financial confidence? There must be some baked into this from the Russia-Ukraine conflict. What are the main drivers over the next year or so that are really going to be driving up the price?
Well, first, I'll point out that this has been CPM Group's longer-term gold price outlook probably for 6 or 8 or 10 years. We've been talking about when the next recession hits, when the next financial crisis hits, gold prices could rise well over $2,000 on an annual average basis. And our price target has fluctuated as the price of gold, the base from which we project, has fluctuated. But this is, it's nothing new for CPM Group to be saying this. Maybe it's something new for people to listen to us, but if you look at it, we're looking at a complex set of economic, financial, and political factors coming together over the next 2 or 3 years. So yes, we're looking at a recession. We're looking at fiscal stringencies, not only in the US government, but around the world, because you've had this incredible fiscal stimuli really for decades, but it's gotten much more intense over the last 3 or 4 years. It can't be sustained. There has to be some fiscal pullback. We're looking at supply constraints in the real economy, not supply chain problems that we had coming out of the pandemic, but actual supply constraints where you can't get certain things because the economies have been growing and expanding. We're not there yet, but you can see that there are constraints on certain sectors of the economy, the real economy, we call it. You're also looking for a cooling of consumer and business spending. It's been very heated up over the last few years coming out of the pandemic. It's probably going to cool off. You've taken on a lot of debt, not just government, but also local governments, corporate and private. And that's probably going to also limit future demand as we run into those supply constraints. Then you're looking at some sort of, and it's funny because one of the things that we've talked about in the last week, we've been saying for some time that financial crises then appear when you get into these economic recessionary periods. And they usually appear in some obscure corner of the debt market. It's not the treasuries. All these people talk about the treasury market collapsing. The US treasuries are the most secure and will be the last thing to collapse. And, just go back to 2011 when US treasuries were downgraded and the world yawned. And the gold price had peaked like at the same time, and it fell sharply for 6 years. So, it's not treasuries, it's some obscure corner of the debt market. And we've been being asked by our clients over the last week, well, is sovereign Silicon Valley Bank some obscure corner of the debt market? And the answer is yes, but we don't think it's the trigger because we don't see those other economic factors and fiscal constraints being problematic yet. We think that you've got another 9 months or so before all of it comes together. Then you have the political situation. You have domestic politics, problematic in the US and probably going to get worse. We're going into an election year next year, which is going to be very nasty and ludicrous, I think is probably the best term for it. You have issues within Europe. There were issues within the EU before Russia invaded Ukraine. They've been put aside for a while, but they will come back. The UK continues to have issues. China has issues that are subsurface, but they're there, and it's quite clear. You had the hardliners win in the Party Congress in November, and they reiterated all of their hardline policies. And then starting in December, they started dismantling them. Well, they were facing 83 cities facing major riots and protest marches. So they got rid of zero COVID. They kind of started being a little bit more quiet and less militant about wanting to take Taiwan by force. And then you have the Russia-Ukraine war. You have issues throughout the Islamic world. People inaccurately say that central banks are rushing into gold. But if you look at the central banks that were buying gold last year, there were 8 that bought significant amounts. 6 of them were Islamic government central banks. So there is unrest brewing in the Islamic world, really from Algeria and Libya all the way over to Indonesia. And I think that that's going to continue to be problematic. So there are a lot of political issues, international as well as domestic. And I think that all of those things become more problematic over the next 12 months. We may actually see a resolution of the Ukraine war by the end of this year. I'm not quite sure. I think people are reading too much into Xi Jinping's visit to Moscow today. And what's going to be important there is not what's said in public, but what's said in private. And we won't know that, but we'll see a shadow of it over the next few weeks, I think. But I think that you're facing massive economic issues, financial market instability, and political issues. You put all of that together, and then you have a 2008, 2009. But it's not March 2008, it's September 2008 when Lehman went bust. And you had massive government responses around the world to trying to right the ship of financial markets.
I just wanted to talk about as well, just touching on that. Where do you see the US dollar going as a safe haven? I think over the last year or so, it's performed relatively well in terms of other currencies. This isn't just a US problem in terms of financial markets. It seemed very global, especially analysis you were explaining there. If the US dollar holds up, is there a potential, even recession or not, that we could see gold prices suppressed slightly?
Well, the dollar has been strong up until September, October of last year. It's come off since that time. It's getting hit very hard today as we speak. Our view is that the dollar probably will stabilize and possibly recover some of what it's lost over the last 4 or 5 months, partly because, again, it's the best place to be. It's the most liquid market. When you're in a financial crisis, you really don't want to move into less liquid markets. You want to move toward the most liquid markets. So I think the dollar probably stabilizes over the next 9 months and possibly shows some strength. But I think the currency markets overall will continue to be very volatile, and that'll be good for gold. Yeah. So even if the dollar rises, I don't necessarily see that being a negative for gold because, it's like, well, why is the dollar rising? Well, the dollar's rising because people are very nervous about other currencies and other economies, and they're moving to the most liquid financial asset they can find. That's a positive for gold. That's not a negative.
Okay. Last question. Other than gold bullion, I wanted to look at gold equities. your view is, at the moment, you're talking about puts. Is this a good opportunity for people to be getting into the gold equity space, gold mining companies, producers, even mid-tier producers, anything along those lines?
I think first off, we're not equity analysts per se. We do study the mining companies because we have to for our gold research and our silver research and all. And we do have private opinions about individual companies and the overall sector. Our view is that some of these companies will do well, but I think it's a very selective thing. We're working very hard to sort of try to distinguish in our mind the companies that we think that will do well versus the companies that will continue to suffer. And you also have to divide, there are two sets of parameters for measuring a mining company's performance. There's the operating performance. How's the company doing financially in terms of production, profits, revenues, net income? And then how's the company doing in the equity market? And there's, I think, some separation between those two. So you can see, just like, again, if you look at Signature Bank in the United States or Credit Suisse in Switzerland, you're not seeing the deposits impaired. You're seeing the equity of the shares of the companies being impaired. And I think that you're seeing sort of the same thing in the gold mining industry too. The performance in terms of operational and profitability has been relatively good, but the share price has continued to suffer. That suggests that there are or should be some really good opportunities, some really good value investments in the gold mining sector.
And if you are going to, say you were going to be advising anyone, if they were looking at mining equities, what would be one of the main parameters? Would it be the margins that they're making at the moment, their gross margins? Or
I think that what you need to do is, clearly the margins are one of the factors, but I think you need to look at how the companies are deploying the increased net income. Are they buying back shares? Are they paying for higher price production in order to have ongoing production? Or are they reinvesting that money in more productive assets, exploration? Are they keeping their G&A, their administrative costs under control? Are they dividending money out to clients? So I think that you have to look not at the margin of the company, but how the management is handling the increased revenue flows that they're getting, thanks to the fact that the gold price is higher.
brilliant. Jeff, thank you for your time.
You're welcome. It's always a pleasure.